If I were walking into the board meeting on Ethereum, this is the one page I would want in front of me. As a startup, I would never fund it. As a network, the market values it near $300 billion. That contradiction is the whole brief. Vitalik Buterin is the central figure, though not in any conventional corporate sense. He wrote the white paper in 2013, launched Ethereum in 2015, and has spent years acting like a founder without the comforting finality of a chief executive. Boards like signatures, Ethereum offers essays. The supporting cast is unusual, even by crypto standards. The Ethereum Foundation sits in Switzerland, developers are scattered across jurisdictions, and major economic power rests with validators, exchanges, stablecoin issuers, and large application teams. The room has no single chairman. It has a crowd, a Discord channel, and occasional theology. The setup matters. Bitcoin proved digital scarcity. Ethereum added computation. That changed the asset from a token into a platform, which is a far more ambitious promise and a far messier one. I have seen boards finance ambition. They prefer ambition with reporting lines. Then came the timing. Zero rates encouraged speculation. Software multiples floated into the clouds, and capital chased anything that could plausibly become infrastructure. Between 2020 and 2021, decentralized finance and NFTs turned Ethereum block space into a scarce commercial asset. People were not buying philosophy. They were bidding for throughput. There was also a prior deal the market half noticed. In 2017, the initial coin offering boom taught founders that tokens could raise capital without venture discipline. Most of those structures deserved a polite burial. Ethereum survived because it was selling the road network, while others were selling roadside attractions. Now to mechanics. Ethereum has no equity, no dividend, and no claim on residual assets in liquidation, because there is no liquidation in the usual sense. Valuation sits on demand for block space, transaction fees, settlement activity, and the belief that the token remains necessary to operate and secure the network. The cap table equivalent is token supply and token distribution. Ether began with roughly 72 million coins after the launch sale in 2014. Today, supply dynamics are shaped by issuance to validators and fee burning after EIP 15-59 in August 2021. Any board packet would flag that on page 1. The economic term sheet improved materially after the merge in September 2022. Ethereum moved from proof of work to proof of stake, slashing energy use and changing issuance economics. A company would have called it recapitalization through engineering. Crypto called it an upgrade and stayed awake all night. Since then, staking has become the financing mechanism that matters. Validators post Ether, earn rewards, and secure the chain. As of this year, tens of millions of Ether are staked. That reduces liquid float and strengthens the perception that Ether functions partly like productive collateral. Markets pay up for collateral they trust. Here's where the deal nearly breaks under scrutiny. Concentration risk sits everywhere. A meaningful share of staking runs through Lido, Coinbase, Binance, and a short list of operators. If this were a normal business, counsel would circle governance exposure in red and ask who really controls the pipes. Then there is the hidden liability. Ethereum depends heavily on stablecoins, especially USDC and USDT, for real transactional utility across exchanges and decentralized finance. A network advertised as decentralized still leans on issuers that can freeze assets, answer subpoenas, and wake up to awkward calls from Washington. Regulation remains the late-night phone call in this story. Is Ether a commodity, a security, or something that changes shape depending on the hearing room? The answer has drifted. Institutions dislike drift. A discount rate moves sharply when the legal classification of the asset feels one committee vote away. Yet the result has been remarkable. Ethereum emerged as the default settlement layer for a large part of crypto finance, token issuance, and on-chain trading. The first-order effect was not elegance, it was usage. Corporate assets are often overvalued on narrative. Networks can be overvalued on necessity. The market open after each major crisis tells the tale. The 2016 DAO hack should have killed confidence. It did not. The chain split, Ethereum survived, and Ethereum Classic became the corporate spin-off nobody ordered. Then came 2022. FTX collapsed, leverage burned off, and Ethereum still kept settling transactions. The first earnings call equivalent is network revenue. In active periods, Ethereum generates fee income that would make respectable software companies blush. Except the income is dispersed across validators and partially offset by burn mechanics, rather than booked cleanly into one income statement. Accountants would reach for aspirin. I have seen a close analog before. In the 1990s, nobody could sensibly value the internet's backbone as a normal company in its early years. Yet, control over protocol layers and traffic bottlenecks proved enormously valuable. Cisco sold picks and shovels. Ethereum sells scarce computation and settlement finality. A second analog is not technology. It is Visa after scale, especially once merchants and banks had no practical choice but to route through the network. Visa looks tidy because corporate wrappers came first. Ethereum did it backwards. First the network effect, then the governance arguments. Then, the adults arrived with compliance binders. What 30 years in the room taught me is that public markets will finance things private committees reject when the asset becomes hard to replace. Venture capital funds management teams. Markets sometimes fund position. Ethereum's position inside digital finance is stronger than its organizational design. And price follows position longer than pride allows. I have seen this before. Here's what it means. The market is treating Ethereum less like a startup and more like a messy utility that became indispensable before anyone wrote proper board minutes. Where have you seen this exact failure mode? Name the company.